Hi, I'm Janet Al-Sad. Joining me today is Mark Mobius, Executive Chairman of the Templeton Emerging Markets Group here in the studio. Mark will share his views and outlook for emerging markets amidst the recent market volatility. Now, Mark, there's been increasing talk of a global recession. What are your views on this?
If you pick up the newspaper, you will find lots of problems, not many successes, but you will have to be careful because the newspapers and the press and TV and so forth tend to emphasize the negative rather than the positive, which is good because it gives you warning signs if there are problems ahead. But we don't think that from a longer term perspective there's going to be recession, not only in the developed countries but also particularly in the emerging countries. The emerging countries, as you know, are growing at 3 times faster than the developed countries, and we believe because of the macroeconomic, population, demographic situations in these countries, the growth will continue. So we're not too worried about recession or depression, but more looking ahead to further growth that we've seen in the past.
The previous 2 rounds of quantitative easing in the U.S. have seen hot money flowing into emerging markets. Now the Fed's considering Operation Twist, trading in shorter-dated debt for longer-term debt in order to flatten the yield curve. What do you think would be the potential impact of Operation Twist on emerging markets?
Not really much impact, simply because it's more money printing with a different name, frankly. So I don't think there's going to be any big change in the way markets are going to be reacting to this sort of thing.
Some analysts have suggested that Operation Twist could lead emerging economies to become even more decoupled from developed economies. What are your views on the decoupling theory?
I don't think markets in this day and age can be decoupled. I do believe that the volatility changing around the world is short term. In other words, markets will tend to move together in a very short time frame because news travels quickly and panic travels quickly now with the new means of communication that we have, internet, so forth and so on. But this is very short in duration. As soon as the initial reaction is over, then the markets begin to take a life of their own because the domestic investor in these markets is becoming more and more important. So I think we have to look at it in terms of different time frames. Short time frame, high correlation, markets move together. Longer time frame, no.
Mark, how do you think the troubles in the developed world impact emerging markets?
The developed markets problems, of course, impact everyone because if you look at the developed countries, they are the big part of the global economy. The biggest economies in the world are the US, Europe, Japan. Of course, China is catching up quickly and India and other countries are catching up, but they're still smaller. So anything happening in the developed countries will affect everyone globally.
Finally, what's your outlook for emerging markets?
Well, as I mentioned, EM are growing much faster than the developed countries. That is not going to be affected because the base is much lower and the opportunities in these countries are much greater. So you're seeing the emerging countries growing at 3 times faster than the developed countries. So even with problems in the developed countries, that situation is not going to change. You're going to still see a multiple of growth in the emerging countries compared to the developed countries.